You're sitting at your kitchen table at midnight, staring at a blank screen on your laptop. You just spent the last year running a side hustle out of your garage, turning a serious profit, and now you're staring down a massive tax bill. You've been hearing guys on the internet yell about forming a limited liability company, or an LLC, and you keep seeing videos about something called an S-Corp. You've no idea what either of them really does, but you know you're tired of handing over a giant chunk of your hard-earned cash to the government. You need to know which one actually saves you money, and you need to know before you mail off another check. Let's simulate exactly what happens when you start a business, hour by hour, step by step, from that late-night kitchen table all the way to your bank account. Keep in mind, this is education about how the system generally works, not legal advice for your exact situation. Tax rules vary by state, and the federal rules have specific cutoffs, so you'll want to consult a local professional before you sign anything. First, we have to walk through what it actually means when you're operating without any formal business setup. Imagine you're the guy who just got paid $10,000 in cash for a massive landscaping job. If you don't have a formal business entity registered with the state, the law considers you a sole proprietor. A sole proprietorship is just a fancy legal term that means you and your business are the exact same entity in the eyes of the law. There's no separation. Here's exactly what happens at tax time with that setup. You take your gross income, which is the total amount of money you brought in before expenses. You subtract your deductible expenses, which are the costs the government lets you subtract from your income to lower your tax bill. Those deductions might be truck maintenance, equipment, and gas. Whatever is left over is your net profit, which is your actual bottom line income. Because you're a sole proprietor, that net profit gets dumped directly onto your personal tax return. You pay ordinary federal income tax on it, but the real gut punch is the self-employment tax. Self-employment tax is the mandatory tax that funds your future Social Security and Medicare benefits. When you work a traditional job for an employer, the company splits that massive tax bill with you, paying half out of their own pocket while withholding the other half from your paycheck. But when you're out there working for yourself as a sole proprietor, you don't have an employer to pay that other half. You owe the entire percentage on your own, and the government takes a serious bite out of your bottom line. Now, let's simulate what happens when you decide to form a standard, everyday limited liability company. An LLC is a legal structure for your business that the state government approves. When you file the paperwork and pay the registration fee, the state creates a brand new legal entity that's completely separate from you as a person. Think of it as building an invisible legal wall around your personal assets. If a customer trips over your equipment and sues the business, or if a supplier gets angry and tries to collect a debt, they generally can't come after your personal pickup truck, your house, or your personal savings account. That protective wall is called limited liability. When you first form an LLC, the IRS looks right through it. By default, a standard LLC with one owner is taxed exactly like that sole proprietorship we just talked about. The money passes through the invisible wall, lands on your personal tax return, and you still owe that massive self-employment tax on every single dime of profit. So, you've the legal protection, but you don't have the tax savings yet. To get the tax savings, people talk about making an election. An election is just a formal piece of paperwork you file with the IRS to tell them you want to be taxed differently than the default setup. This is where the S-Corp enters the simulation. An S-Corp isn't actually a separate type of business entity that you register with your state the way you do with an LLC. Instead, it's a specific federal tax status. You pay the standard taxes on that $50,000, but your business actually netted $80,000. That remaining $30,000 is taken as a distribution at the end of the year. You still pay standard income tax on it, but you completely skip the massive self-employment tax on that $30,000. Depending on your exact numbers and current tax brackets, that single move can save you thousands of dollars every single year. So the S-Corp election sounds like an absolute magic trick, but let's simulate the catch. Running an S-Corp takes a lot of heavy lifting. You can't just draw cash out of the business checking account whenever you feel like it anymore. You have to actually run formal payroll. That means you either have to buy expensive software every single month, or you have to hire an outside accountant to cut your paychecks and file the proper quarterly tax forms with the government. You'll also have to file a completely separate, highly complex federal business tax return every single spring. Those accountant fees and software costs can easily add up to thousands of dollars over the course of a year. If your business isn't making a very consistent, high profit, the cost of running the S-Corp payroll can actually eat up all the money you saved in taxes. There's also a massive legal trap with an S-Corp election that the internet gurus completely ignore. When the IRS tells you that you have to pay yourself a reasonable salary, they mean it. The IRS isn't stupid. You can't just pay yourself a tiny salary of $10,000 a year and then take a $70,000 distribution just to dodge the self-employment tax. If the government audits your business and decides your salary is unfairly low compared to the actual work you do and the money the business makes, they'll hit you with massive penalties, back taxes, and severe fines. The law demands that your salary matches what you'd legitimately pay a stranger to do your exact job. These specific numbers vary heavily depending on your local industry, so you absolutely need a certified accountant to help you calculate your exact reasonable salary. Let's simulate how you actually make this choice without blowing your foot off. Picture yourself at the bank, opening up the business checking account. If you're just starting out, or if your business only clears a small profit of $20,000 or $30,000 a year, you simply form a standard LLC and leave it alone. The cost of setting up payroll and hiring a CPA to process the complex S-Corp tax returns will far outweigh any tax savings you might see. You take the legal protection of the LLC, you swallow the self-employment tax, and you keep your paperwork incredibly simple. But picture yourself at the bank 2 years later. Your reputation has grown, your client list is massive, and your business is clearing over $60,000 or $70,000 in pure profit every single year. Now the math starts working in your favor. The thousands of dollars you save in self-employment taxes by taking a large distribution will easily cover the accountant fees and the payroll software. That's the exact moment in the simulation when you sit down with a tax professional and ask them to file the S-Corp election for your LLC. You have to look at your local state laws too. Some states charge LLCs a massive annual franchise fee just for the right to exist, and other states actually charge extra fees specifically if you choose the S-Corp tax status. California, for example, hits S-Corp with a yearly franchise tax bill that can instantly wipe out your early savings if you aren't making serious money yet. New York has entirely different rules about how they tax these entities. You have to know exactly how your state treats these business structures before you send off your election paperwork, because local rules change the entire math of your business. The entire legal system is built on these specific timelines and triggers. You form the entity to get the legal wall, you wait until the profit is high enough to cover the extra accounting costs, and you make the election to trigger the tax savings. If you do it out of order, or if you do it too early, you'll drain your bank account on legal fees and complex tax returns before you ever see a dime of real profit. If this breakdown helped you figure out the exact right time to switch your business structure, pass the video along to a buddy who is currently stressing over their own massive tax bill. And make sure you subscribe to Scribble Law so you always know the actual rules of the game before a costly paperwork mistake tries to drain your bank account.